All right, let's dive right in. Today, we're breaking down a trade setup I really like, mainly because it gives us a super clear line in the sand for managing our risk. Let's get to it. You know that feeling when you're in a trade and the bottom just feels like it could drop out at any second. It's the worst. But what if? What if you could find a setup where the big money, the institutions, have basically drawn a support line in the sand for you? Well, that's exactly what we're going to break down today. So, the stock we're zeroing in on is BioAge Labs. The ticker is BIOA. And listen, this thing is giving us a textbook example of a pattern I love to trade. I call it the offering floor play. And the best part, it's setting up right now. Okay, so here's the core of the idea. BIOA is just hanging out, consolidating right around $19.50. Now, that is not a random number. It's a hugely important level because it's where institutions bought in during a recent stock offering. Let me show you exactly what that means. Right, so this term, the offering floor, what is it? It's simple. It's the price where the big money, the huge funds, bought a massive block of shares right from the company. They've got serious skin in the game at that price, and they're going to want to defend it. For us, that can act as a really powerful support level. Okay, so is this all just a nice story? Not at all. Let's actually dig into the evidence because you'll see that both the technicals on the chart and the fundamentals of the company are pointing to the same thing. So when you look at the technicals, it's pretty interesting. The RSI is just chilling out, totally neutral. The price is sitting right on its 20-day moving average, and the MACD is starting to flatten out. See, this doesn't scream buy me now. What it does scream is consolidation. The stock is like a coiled spring, just building up energy for a move, and it's doing it right on top of that floor we talked about. But the chart is only half the story. The real reason the big money is paying attention is this. 86%. That's the number. Just let that sink in. That is the reduction they saw in a critical inflammation marker in their recent phase 1 data. I mean, that result is potentially best in class, and it is the fundamental engine that's driving this entire trade idea. And look, the fundamental story just keeps getting better. It's not just about that one piece of data. You've got analysts with a consensus price target way up at $33.33. The company is absolutely flush with cash. We're talking about $400 million. That gives them a cash runway all the way to 2029. You know what that means? The risk of them needing to sell more shares and dilute everybody is super, super low. All right, we've got the why, we've got the evidence. Now let's get to the most important part, the how. I'm talking about an actionable trade plan with the exact levels for our entry, our stop loss, and our targets. So here's the plan. We're looking for an entry right at that offering floor, $19.50. Simple. And our risk, it's perfectly defined. If this thing breaks down below the lower Bollinger Band and our line in the sand is $17.90, we're out. No questions asked. We take the small, manageable loss. So where are we heading on the upside? Well, target number 1 is that 50-day moving average sitting right around $21.17. That's a nice, logical first place to take some profits. But if we get a real pop, if the momentum really kicks in, we're looking at target 2, a clean $23. And that, by the way, happens to be Morgan Stanley's price target. Okay, let's put it all together on one screen. This is where it gets good. We're risking about 8.2% to make 8.6% on that first target. That's a solid 1-to-1 risk to reward. Love to see it. But if this thing really gets going and hits target 2, our reward jumps to over 2-to-1. Now that is the kind of asymmetric bet we are always hunting for. Okay, hold on. No trade is ever a sure thing, right? We're not amateurs here. We have to be professional and look at the other side of the trade. So let's do a quick reality check and talk about the risks versus the potential upside. So on the risk side, the big headwind is pretty obvious. This is biotech. Bad data can come out of nowhere, and if it does, that floor isn't going to hold, period. We're also seeing a big jump in short interest, which tells you there are definitely people betting against this stock. But on the flip side, the tailwinds are pretty clear. You've got more data coming in 2026, a new trial starting up. There's a clear path forward here if things go right. So when you boil it all down, I want you to remember this one thing. A defined floor like this gives us an opportunity. It does not give us a guarantee. It's all about having a tactical edge and a crystal clear risk management plan. And that's really the question we're left with, isn't it? You've got this amazing, compelling data pulling it up, and you've got this growing skepticism trying to push it down. So is that institutional floor at 1950 strong enough to be the launch pad for the next leg up? All right, that's the setup. And as always, please remember, this is all for educational purposes. It is not financial advice. You've got to do your own homework because trading is risky business. We'll catch you on the next one.